Is a market crash coming in 2026? That's the question a lot of investors are asking right now. Every time there's uncertainty, whether it's inflation, interest rates, global tension, or economic slowdown, headlines start screaming the same thing: crash coming. And when people hear that word, they panic. They stop investing. Some even sell everything. But here's the truth. Smart investors don't panic during crashes. They prepare for them. And in many cases, they profit from them. First, let's understand something clearly. Market crashes are normal. They are not rare events. If you look at history, the stock market has experienced corrections and crashes many times, and yet over the long term, it has continued to grow. The problem isn't that crashes happen. The problem is how people react when they do. Fear causes emotional decisions. Emotional decisions destroy portfolios. Right now in 2026, there may be economic uncertainty. Interest rates may be shifting. Certain sectors may be slowing down. And yes, volatility might increase. But volatility does not automatically mean disaster. It means movement. And movement creates opportunity if you know what you're doing. So what are smart investors doing right now? First, they are not trying to predict the exact timing of a crash. Trying to perfectly time the market is one of the hardest things to do consistently. Even professional fund managers struggle with this. Instead of predicting, smart investors focus on preparation. They build portfolios that can survive downturns. One major thing smart investors do is diversify. They don't put all their money into one stock, one sector, or one trend. They spread their investments across broad market index funds, different industries, and sometimes even different asset classes. Diversification reduces the damage if one area drops significantly. If tech struggles, maybe healthcare or consumer staples stay more stable. The goal is not to eliminate risk, it's to manage it. Another thing smart investors are doing right now is strengthening their emergency fund. Before thinking about aggressive investing, they make sure they have cash reserves, typically 3 to 6 months of living expenses in a high-yield savings account. Why? Because if a crash happens and you lose your job or face an emergency, you don't want to be forced to sell investments at a loss. Having cash gives you flexibility. It allows you to stay invested instead of reacting out of fear. Smart investors are also continuing to invest consistently. This surprises many beginners. When the market drops, headlines scare people into stopping their contributions. But experienced investors understand something powerful. When prices fall, assets go on sale. If you're investing for the long term, lower prices can actually improve your future returns. This strategy is called dollar cost averaging. You invest a fixed amount regularly, whether the market is up or down. When prices are lower, your money buys more shares. Over time, this can significantly boost growth. Another key behavior is focusing on quality. During uncertain times, smart investors lean toward strong, established companies with solid balance sheets, consistent earnings, and proven track records. These companies are more likely to survive economic downturns. Speculative stocks, on the other hand, often get hit the hardest in crashes. High hype, no profits, heavy debt, those are usually the first to fall. Smart investors reduce exposure to extreme speculation when uncertainty increases. They also avoid panic selling. Historically, some of the biggest market gains have happened shortly after major downturns. If you sell during fear, you lock in losses. If you stay invested, you participate in the recovery. The market doesn't send invitations before it rebounds. It often recovers when sentiment is still negative. That's why patience matters. Now let's talk mindset. Smart investors understand that volatility is the price you pay for long-term growth. You cannot expect high returns without temporary declines. The market rewards discipline, not emotion. Instead of asking, "How do I avoid every drop?" they ask, "How do I build a strategy that survives drops?" In 2026, what might that strategy look like? For many investors, it means keeping a strong core position in broad market index funds. It might mean maintaining exposure to defensive sectors like utilities, healthcare, or consumer staples. It may also mean reducing overconcentration in highly volatile sectors. And most importantly, it means staying consistent with long-term goals. Another thing smart investors are doing right now is reviewing their risk tolerance. If a 20% drop would cause you to panic and sell, your portfolio may be too aggressive. Adjusting asset allocation, perhaps adding more stable investments, can help you stay calm during downturns. The best portfolio is not the one with the highest theoretical return. It's the one you can stick with emotionally. It's also important to remember that not every downturn becomes a full crash. Markets correct regularly. A 10% drop is common. Even 15, 20% pullbacks happen periodically. But over decades, the overall trend has historically moved upward. Long-term investors who stayed disciplined through multiple downturns have often been rewarded. So is a crash coming in 2026? Maybe. Maybe not. The honest answer is that no one knows for sure. What matters more than predicting the crash is preparing for it, because preparation removes fear. Smart investors right now are not frozen. They are not obsessively watching headlines. They are not making drastic emotional moves. They are building diversified portfolios, keeping emergency cash, investing consistently, focusing on quality, and thinking long-term. If a crash happens, they will see it as a temporary storm, not the end of the world. And if it doesn't happen, they will still benefit from staying invested. The difference between those who build wealth and those who struggle in the market is rarely intelligence. It's behavior. During uncertainty, average investors panic. Smart investors stay disciplined. If you want to win in uncertain times, focus less on predicting headlines and more on strengthening your strategy. Because whether 2026 brings a crash, a correction, or continued growth, the investors who stay calm and consistent are usually the ones who come out ahead.